Hello and welcome everyone. My name is Zoe Lamb and I'm the host for today's webinar, Analysing the 2020 FX market and what to expect for 2021. Thank you all for joining us today. Before I introduce the speakers, there are a few housekeeping points I'd like to cover. At the bottom of the webinar screen, you should see a toolbar. You can use this toolbar to access a range of applications such as additional FX resources and speaker bios. Click on the application and it should open on your screen. All applications are resizable and movable, so feel free to move them around to get the best user experience and to make use of your screen space. Should you have any questions, please feel free to submit them to the speakers throughout the session via the Q&A box. We value your feedback, so please do complete the pop-up survey at the end of the webinar. Let me now introduce our speakers for today. Our moderator is Ken Monahan, Senior Analyst on the Market Structure and Technology team at Greenwich Associates. Ken is responsible for the FX vertical, and prior to joining the firm, Ken operated a market structure consulting practice that included work in FX, listed derivatives, fixed income, and fintech, serving regulators, investors, and other industry participants. Previously, he was the Global Head of Business Development for Equities at Deutsche Bank, a role which he addressed market structure issues in both developed and emerging markets, executing first trades on both ISE in the United States and the DIFX in Dubai. Our second speaker is Neil Penny, Managing Director and Head of Foreign Exchange at Refinitiv. Neil is responsible for our global FX business, which provides pre-trade insight, execution capabilities, and transactional workflow solutions for sales, trading, and research of FX. Prior to joining us, Neil was Managing Director and European Head of Fixed Income e-Trading Strategy at Morgan Stanley. He is also a member of the London and New York Foreign Exchange Committees and Vice Chair of the Global Foreign Exchange Committee. And last but not least, we have Jim Kwiatkowski joining us too. Jim is a Global Head of Transaction Sales at Refinitiv, which encompasses both client relationship management and new business teams for the buy-side and sell-side client segments. As Global Head of Transaction Sales, Jim is responsible for the growth of revenues, client retention and acquisition for our FX trading products, FXall and Matching. Jim joined Thomson Reuters in 2012 as part of the acquisition of FXall, where he was also Global Head of Sales. Our speakers will now begin this session, starting with a review of the FX market during this year, and will provide a view of what to expect in 2021. We hope you enjoy the session. Now over to you, Ken.
Thank you so much, Zoe. So before we begin to look at 2020, keeping in mind that perhaps the most interesting thing going on in the world is an election, I thought maybe we'd take a step back and look at the last election. And it's hard to believe that the 2016 election now feels like a calm and idyllic past. But you could see that there was quite a bit of excitement in the foreign exchange markets that year, as the dollar Mexican peso rate moved quite a bit on the back of the election of Donald Trump. Jim, do you have any thoughts about how things went back then?
Yeah, thanks, Ken. And with everyone still talking about the 2020 election, it is interesting to reflect back on the last election in 2016. Obviously, currency traders are always very focused on macroeconomic events and closely watch each U.S. presidential election for market moves. In the days leading up to the last presidential election in 2016, the polls had clearly favored Hillary Clinton over Donald Trump on the evening of Election Day, November 8th. And most people, I think, as they left their work and returned home, expected that they already knew the results. Now, throughout the race, there was a great deal of focus on immigration issues, and Donald Trump had made Build the Wall a rallying cry. And throughout 2016, as a result, the Mexican peso weakened from less than 16.5 in late 2015 to nearly 20 in late September 2016. But the peso was strengthening in the final days leading up to the race, with the market expecting a Clinton victory until 8 p.m. that night. 8 p.m. Eastern Time, election night, when a few polls in some states were first closing, but long before the first media outlet would call the election, the peso quite suddenly started to quickly climb from 18 to 21 the next day before the election was called for Trump. as Trump began to unexpectedly win some pretty large states, signaling a change of expectations in the market before the election was called.
Yes, that's and you can see that was a pretty dramatic move. But I think this time around is interesting, and a more interesting currency pair to look at is perhaps dollar RMB. Neil, do you have any thoughts on this?
Yeah, thank you, Ken. So we picked China because the movements in China are best correlated to the politics as it was evolving. So similar to the story Jim outlined, the polls were confident of a Democrat victory. And you see that in bar number 1 on that chart here. The currency starts appreciating as people were confident that Biden would win. But then actually, as the votes started getting counted, it became clear that the polls had been wrong. And suddenly there was a depreciation in the currency as people thought that perhaps Trump might win after all. And that's bar number 2 on that chart. And then by the early morning in London time, it became clear that while it was much closer than expected, Biden would win. And so the currency resumed its appreciation. And that's bar 3 that you see. And that continued all the way through the rest of the week. The other thing we've highlighted down at the bottom chart, which shows the amount of volume being traded in the market, is all the trading that occurred during Asia hours while this switch was going on. So it did have a bit of drama, but it's nothing like the drama of 2016. I mean, just to put some sense of scale on these 2 charts you've just looked at, Mexico moved 10% in the chart that Jim just talked you through. Here we're looking at a 0.2%. So it is literally a minor wiggle in the currency rate in comparison.
Well, a rare piece of calm for 2020, I guess, at least on a relative basis. So that brings us into the structure of the rest of the webinar. So we're going to change this a little bit from how many reviews of 2020 have gone, and rather than focus on sort of a chronological replay of the year, we're going to focus on sort of areas of customer interest, right? So 2020 presented a lot of challenges. People had to respond in various ways, and so we're going to focus thematically on safety, efficiency, liquidity, flexibility, and sort of the search for insights. And then at the very end, we'll discuss 2021. So the first area we're going to look at is in efficiency. And as you recall, simultaneous with the crisis, there was also a disaggregation of the world financial system as lockdowns required many people to work from home. Refinitiv has looked at their clients' experiences of this, and they have some interesting insights here on how this broke down by region. Jim, do you want to speak to this a little bit?
Sure. Thanks again, Ken. So, we're privileged to have so many market participants as clients across our FXall and matching products. And so earlier this year in June, after the most dramatic events of the crisis had subsided, Refinitiv surveyed 1,000 of our FX trading customers to get their views on how COVID-19 had impacted their FX trading businesses. The clients we surveyed were a diverse group, including asset managers, hedge funds, corporate treasurers, and bank traders, and we surveyed them from 50 different countries. With so many of our clients suddenly needing to work from home in Q1, the first question we asked was, what have been your biggest challenges working from home? Home may have meant some other virtual office environment for some clients. For obvious reasons, market conditions was called out as a challenge. But overall, the biggest challenge was communication. Communication with colleagues in their own firm, communication with clients, and communications with dealers. Market participants clearly missed the ability to share ideas and market color internally and externally as they found themselves in many cases transitioning from a busy office environment to working in a room alone. Other significant challenges that were called out were the availability of bandwidth in America, application latency in APAC, which is obviously related, and just the lack of critical systems at home as market participants needed to quickly transition from having everything they needed on a trading desk to having precious little screen real estate, limited bandwidth, and not all the applications they needed installed at home.
That's interesting. It's interesting that communication was such a large aspect of that. And your survey was quite robust. You had another question asking about what the biggest trading challenges were in Q1. This was a little bit more uniform in the responses. Neil, do you want to speak to this chart?
Sure, thank you. So I think the biggest thing that comes up in all three charts is the increase in spreads. And we're going to spend some time later talking about and showing how spreads increased through 2020. Beyond that, we have this red block, which is access to liquidity, which is the biggest issue for everybody. And that relates to the fact that the market didn't work quite as smoothly as it had done pre-crisis. And we're going to talk about that in some of the previous slides, but the market has become very used to request a price on an e-dealer screen, the price comes up, you click it, the deal's done, you go on to the next deal. And over the years, of course, workloads have increased as people have done more and more deals, as markets have grown and desks have shrunk. And as soon as you start putting any complication in that, as Jim said, people are working from home, the markets are more tricky, latency matters, suddenly that kind of efficiency really comes to the forefront. And that was something that in all regions people noted as a challenge, just kind of continuing the pace at which they'd been used to executing previously.
I think that actually is a very good transition to the next slide, which is a closer look at what precisely these challenges were.
Thanks, Ken. Yeah, so here we're looking at last look rejection. So I'm sure everyone on the webinar knows, but the last look check is where you as a customer click on a price that you want to trade on. But before that gets back to the bank, the market's moved and the price is now old and the deal gets rejected. That is a kind of an operational challenge for a buy-side customer because the trade they thought they had, they now have to resubmit. The market may have changed materially. Generally on FXall, and we're looking at FXall reject rates here week by week through 2020, generally on FXall, reject rates are really low. As you see from the left-hand side of the chart, blue to the left of the solid blue bars, they run at about 2 to 3%. In other words, 97, 98% of click to deals turn into trades. And it's only really at the margins that the market moves and a trade request is rejected. And that shouldn't be surprising because our customers are good customers of their banks. And we and our customers and our banks all work hard together to ensure that last reject rate is as low as possible. So we go into the solid blue. That's the critical 6 weeks of the crisis. What you see is a sudden increase in last look reject rates, up 10%. And remember, that's the average for the week. So on key days, it was probably more like 12 or 13%. Well, if you think about having a batch of 100 trades to execute and suddenly 10% of them come back as rejections, that's a material number of trades you have to resubmit. So we're going to look in a minute at some of the causes behind that and what the industry did to kind of bring that under control through the rest of 2020. But it's just worth following the trajectory through the rest of the year. So following the end of March, which was a very, very busy quarter turn, if you remember, the market went very quiet. I think collectively all of us heaved a sigh of relief that we got through March, and we took a breather in April. And you see that last look reject rate coming right back down. And gradually it stabilized through the year. And it didn't quite get back to where it was, but it got back into the 2 to 3% range. And you see, if you look at the quarter ends and the month ends, they tend to be a bit busier, and you get a little bit of a spike there. And of course, recently we just had the US election, which means it's gone up right at the end. We've had the October month end, followed by the US election. But I think those are, if you like, aberrations. And next week we'll start to go into the 2%, 3% average. So I think it's a nice picture that illustrates a crisis in the market in terms of people being able to trade the way they used to. And then the industry correcting that through the year and the crisis passing.
I think that is very clear, and I think this is seen again in the next slide, which is looking at market speed and market data rates.
That's right, Ken. Thank you. So what we're looking at here is how many quotes on FXall did it take for the customer to complete their trade, and that's a proxy for how fast the market was moving, how fast bank rate engines were quoting. And to make these numbers digestible, we've actually normalized things so that 100% here corresponds to the level pre-crisis in 2020, the first 6 weeks of the year. And once again, the dark blue corresponds to the 6 weeks in the middle of the crisis, mid-February to the end of March. Well, look at the scale here. That number goes up to nearly 350%. That means banks were quoting 3 to 4 times faster in the peak of the crisis than they had been just a few weeks ago. If you're a customer running an e-trading system, you're now receiving 3 to 4 times as many quotes as you were. And remember, you were probably doing that not on the PC that your company had provided and tested for you, but whatever computer you happen to have in your home at the point lockdown started. 3 to 4 times as much data to process. If you were in the business of storing quotes, there was 4 times as much data to store. It was an absolutely huge impact on the market. And I think it's a real credit to the capacity work that the industry's done over the past 10 years, that actually you can load the systems up to 4 times what they were used to with minimal notice. And broadly, everything came through unscathed, right? There were no major market incidents through the crisis. There were no customers who were unable to achieve their trading needs. I think this is a really nice chart that shows the resilience the FX industry has built up among itself over the past decade. The other thing you'll notice as we go to the right hand of the chart is that the numbers didn't come back down to 100%. They didn't re-normalize fully. We'll see later on that trading volumes are actually a little bit lower than they were pre-crisis, but actually the pace of the market is probably about 50% higher than it was at the beginning of the year. So the industry hasn't quite settled back down to how it was. The market still feels a bit thinner, and that's showing itself up in still faster quoting and shorter-lived quote frequencies than before.
I think actually, thinking about these two things in combination kind of brings us to the next slide, right? So one, you had a slight increase in reject rates, but you had a gigantic increase in quote volumes. And then if you look at these, this ratio, you get sort of a very interesting picture.
That's exactly right. We wanted to look for some way of demonstrating with data that the industry had been working on improving resilience, improving last look efficiency through 2020. And the ratio that you've just mentioned is the one that we're looking here. So generally, we know that rejections will go up if quote frequencies go up. So the question is, if you double the amount of quotes you're sending, do you double rejections? Do you more than double them, or do you less than double them? So first yellow box, in the early days of the crisis, actually the rejections rose far faster than the quote frequencies. In other words, the market didn't know quite how to handle the extra volatility, the shorter-lived quote durations, and so rejections actually rose faster than you might expect. And then, as I said, as we exited Q1, end of March, the industry heaved a sigh of relief, and everybody got to essentially retuning their rate engines. In the case of FXall, we made 3 or 4 capacity enhancements just to ensure that quotes followed through our system as fast as possible with a minimum impact. And what you see here is that ratio coming down all the way through the year to where it's comfortably below 100%. In other words, by the end of the year, as an industry, we've actually built up more resilience to increase quote frequencies than at the start of the year. And for a given number of quotes and a given quoting speed, we're actually seeing fewer rejections than we might have expected in January.
That's interesting. So in a way, the industry response to the crisis has sort of improved the quality of the infrastructure overall. That's very interesting.
That's right. It's a nice story.
And it's persistent. So this sort of wraps up our section on the efficiency, and it brings us to our next, which is the liquidity picture that we saw. And first, we're going to look at developed markets. You could see here, 3 pairs, dollar euro, dollar yen, and sterling dollar, and you could see, this sort of rapid spike in quote spreads, but then these sort of taper off quite quickly. This will stand in contrast to the next slide. But did either of you want to make any comments on this before I move to the next?
Thank you, Ken. I'll just add a few remarks. It's worth contextualizing this, I think. So for most of our customers, hedging is a cost. It's a cost of either being a corporation and doing imports and exports, or it's a cost of an asset manager and wishing to acquire or divest foreign securities. And so when FX spreads go up, essentially their operation becomes more expensive. The spread's twice as large as it was a week ago. That part of their cost base has now doubled. And so it imposes a real operational burden on the buy side as spreads went up. And it's worth looking at that 2 to 3x in the same way you might have looked at the 1970s oil crisis, where it cost 4 times more to fill a tank of petrol up than it did before. I think the numbers may not be that visible on the screen, so it's just, we've called out some of the key data here, but generally things peaked at 2 to 3x. They calmed down pretty quickly, but on the whole, they haven't quite returned to where they were before. So euro dollar is hovering around 1 to 1.2x. Sterling is 1 to 1.3x. There's obviously quite a lot going on in the UK at the moment, not to do with coronavirus. And then yen is in the 0.8 to 1.2 range. So that's actually centered around where it was before. But overall, a real sense of a crisis having passed and things more or less having returned to normal.
Certainly.
So, Ken, I think one of the things we saw that was an interesting response to the widening of spreads is a very, very normal behavior for asset management clients over a long period of time is rolls at the end of the month, corporates as well, and then quarterly rolls at the end of the quarter. And what we saw is a behavioral shift where we saw not all of that volume spike at the end of the quarter, but rather we saw it kind of normalize across June, for instance, and then across September, as I think customers sought to minimize the impact of reduced liquidity and widening spreads by moving some of those trades a bit earlier so that they wouldn't participate in such a large spike at the end of the quarter.
Boy, that's really interesting. I think this sort of stands in stark contrast to our next slide, which is the effects on emerging markets that the crisis has had, and this varies quite widely depending on the market that you're looking at. Do you want to speak to that as well, Jim, while we're on it? I know you both have thoughts on this.
I think I'm going to pass this one to Neil. Neil prepared this slide.
Thanks, Jim and Ken. Perfect. So if you're wondering why the bars were so small on the developed market slide, it's because we needed more y-axis to get the emerging markets. We carefully picked three currencies that told three interesting stories, and there's a huge diversity of outcomes in emerging markets. Let's start at the top. So we're looking at China again. It actually looks very, very much like the developed markets that we saw previously, and that shouldn't be a surprise because while it's categorized as an emerging market, it's now the world's second largest economy. Post-crisis, actually, spreads have consistently come under where they started before the crisis at about a 0.8, 0.9 ratio. You can see on the very right-hand side of the chart that they peaked a little with the US election, as we were talking about earlier. What we see here is a reflection of a major developed economy that came out of coronavirus quite decisively and quite early, and therefore has had a very strong economy relative to the rest of G10 through 2020. We look at Mexico. The peak there is 8.1 times where it was before the crisis, and there's no real sense here that a crisis has passed. What you see is this incredible jump up in spreads the week of the 9th of March. Even by the end of May, the spreads were still at 3 times where they'd been before the crisis. And even now they're at 2 times. And there's a general theme here that in emerging markets, countries have been subject to a general risk-off type move by investors. So what you see is a very, very quick withdrawal of liquidity and investment activity out of emerging markets. I remember looking at a chart back in February saying if you didn't know where coronavirus was, you might assumed it had started in South Africa, because it was one of the very first countries to show a depreciation this year. And then finally, we have Turkey at the bottom, which is literally off the charts as we design the charts. And of course, what's happened in Turkey is it started with a coronavirus crisis, but that has morphed into a general currency crisis involving central banks, investors pulling out, and a general wariness of the financial community to re-enter Turkey. So at this point in time, we are still almost 9-10 times where we were at the beginning of the year in terms of spreads, and obviously a much thinner market coupled with that.
Yeah, it's so interesting to see that. I mean, it's almost as though, I mean, the magnitude of those changes is quite significantly larger than the coronavirus issue, which seems actually fairly gradual relative to this. It's been a very interesting year across developed and EM, to be sure. And this brings us to our next issue, which is flexibility. Right. So as we've talked about, clients faced a lot of challenges in 2020, and so they had to show a lot of flexibility in how they dealt with those challenges. And as you guys have gone out and asked your clients about, how they adapted, one of the things you asked was about the reliability of different execution methods. Jim, do you want to speak to this slide a bit?
Sure, Ken. So with spreads widening and liquidity conditions becoming more difficult, access to a variety of relationship banks became critical, as those relationship banks act as the liquidity providers and provide that flexibility of execution, particularly when times are difficult. This flexibility of execution became really critical, and we asked our clients which execution methods they found to be the most reliable during this period of crisis. Not surprisingly, electronic trading methods generally were relied upon more than voice trading. But while the growth of EFX trading is a long-term trend, during the crisis, our clients were contending with many working from home kind of issues that we talked about earlier. And they were looking to reduce that risk in addition to market risk and looked for ways to execute quickly and efficiently under these challenging conditions. So due to the nature of the different market segments, bank had both streaming risk transfer and primary market trading in a tie as the most reliable trading methods for that segment. Maybe more so primary market for the largest global banks, and more so streaming risk transfer for tier 2, tier 3 banks. Within our corporate and our asset management segments, streaming risk transfer was far and away the most reliable. It's interesting to see that voice trading was still 10 to 12% relied upon by corporates and asset managers. But interestingly, we saw a growing reliance on something we call send details, which allowed those clients to electronically confirm the voice deals that they chose to do, and that helped them to reduce trade entry and STP errors. While not as prevalent as these other methods, we definitely saw an increase in the use of bank algorithms and other algorithms such as auto execution within our workflow systems that allowed the customers to quickly eliminate large blocks of smaller trades and to focus their energy on the trades that they thought they added the most value to under these extreme market conditions.
Well, that's interesting. It's interesting to notice that the send details is larger than the voice for corporations. Was that unique to the crisis, or was that something that had been growing over time?
Well, so generally, we're not certain how much voice trading customers are doing, but within this survey, that's the response we got. I think you could say the send details and the voice are synonymous, right? The send details is a electronic confirmation of a voice trade. But yeah, it was interesting to see that more of our customers during this period said that they relied more on send details than voice itself. And I think that's, again, to eliminate those errors, facilitate straight through processing while they're working from home and they don't have the general office environment and risk management systems that they're accustomed to.
Sure, that's very interesting. And to follow on the earlier point that you made regarding algos, right? You have another chart here about the spike in algo usage that you saw.
Perfect. I'll take that one, Ken.
Sure.
So this really is a data point that illustrates the point Jim was making. Customers need a variety of execution techniques, and they need to be able to move between them flexibly as the market changes and their needs change. And this chart of algo volumes is a real case in point. So what we're looking at here is the volume of algos executed on FXall by buy-side customers. And we've based the charts at the 100% is the average level over 2019. So effectively, we're talking about 2020 versus 2019 with each number.
Sure.
And what you can see is this huge spike in March goes up to over 3 times. And what happened is in the peak of the crisis, when spreads had got so expensive, as we just looked at, algo usage rocketed because many customers said, spreads are so high. Maybe I can use an algo to reduce the cost of my trading. Perhaps I can pay less bid offer spread. Potentially, I may even earn bid offer spread by leaving an order in the market that somebody else takes. And not only that, that's kind of the execution cost. But at the end of that, I'll have a transaction cost analysis report, which will indicate exactly where the liquidity came from. It will demonstrate that I achieved best execution. And if somebody said, why is your hedging cost for this month 3 times higher than normal? I've got some real evidence to show them about my trading process and the results. So we do think that algo usage and TCA are very coupled. They grew significantly when it became much harder for customers to be confident they understood where the market was. As the crisis eased, people tended to revert to the trading habits that they were used to that served them well in calmer times. But it's worth seeing that that didn't return to 100%. The level is still higher than 100%. So generally over time, algo usage is growing. And what we've seen here is customers who have tried algos a bit more and found that to some extent they do fill a niche for certain types of trading, and they've kept some of that on. So I think that generally is aligned with a trade of this is going to grow over time, and the industry's just got a little bit more comfortable with it in 2020.
Sure. It is dramatic, though, to see like how large that spike is and how rapidly it sort of reverts to, again, as you mentioned, not normal per se, right, but only slightly elevated rather than 3 times as elevated. So this brings us to.
Just to finish up that
I'm sorry. Go ahead.
So just to finish up that point, that's why it's so important that customers need to be able to have a blotter of all the trades they need to do and zero friction between sending something off for an algo or a resting order, an RFQ or a send details, because the market changes so quickly.
Oh, indeed. I'm sorry, Jim, did you have a comment there?
Yeah, I was just going to say, I think it goes to the fact that the clients do need flexibility, which is the headline of this section. And there are a variety of different execution methods and different market conditions with a variety of liquidity providers. The clients do more often than not choose to look at a variety of market of liquidity providers and leverage that streaming risk transfer. But the algorithms are a very important tool. And so what we've seen is that they need to leverage those tools from time to time and change what they're doing to fit both the moment and the trade they're trying to execute.
Sure. I mean, this is kind of an interesting feature of FX markets, generally, is that there is a lot of flexibility in execution methodologies that you mentioned, and the ease, and this is a dramatic illustration of that. The ease and speed with which the FX market participants can sort of pivot between the different execution methodologies, or, as we were just discussing, sort of combine them in a way where, you electronically process a voice arranged deal. So you sort of take advantage of 2 different aspects of the market structure at once. And this is a great slide for that, I think. So this takes us to our next section, which is sort of a set of insights on what could be learned about the trajectory of markets over the entire year. So I want to sort of first, you can see this, which is sort of the pre-crisis to the crisis peak changes in matching liquidity. Do you want to speak to this?
Thank you, Ken.
Neil.
So this, unfortunately, is the weird science part of the webinar. There's a lot of complexity in this chart. So we've done our best to label it up and make it understandable, but we wanted to share some of the insights we've gained from the markets in 2020 and to illustrate them with data from our platform. So you're looking here at 2 sets of charts. There's a blue bubble chart on the left that represents developed markets, and there's an orange bubble chart on the right that represents emerging markets. For each bubble chart, as you go left to right, we're talking about how much volume was traded. Did it go down on the left or did it go up on the right? And as you go up and down, we're talking about the spread levels. Did spreads get wider as you go up the page or narrow as you come down the page? And then finally, the size of the bubble is about how much volume was traded on matching during that period. So as you said, we're comparing here, what did the crisis look like to how it was before in 2020? If we look at developed markets first in blue on the left, what you see is they've clustered fairly closely together, and you would expect that from when we looked at the FX all spreads a few slides ago. And generally, we're looking up to a 50% increase in volumes, and on average in this crisis period, a 50% increase in spreads. As we saw previously, the worst days were substantially wider, but on average, it was about 50% more expensive in the interbank market on matching to trade developed market currencies. If we look on the right-hand side for emerging markets, immediately see a huge diversity of outcomes. Not everything got busier, not everything got quieter. There's minus 40% at the low end, all the way up to plus 40, plus 50% at the high end. And then the spreads went all the way up to twice as wide on the interbank market. So what you see is very much a country-by-country assessment as we went into coronavirus, impacting each different country. You'll also see China is right down at the bottom of the emerging markets in terms of the spread impact. And as we noted previously, it doesn't really trade anymore as an emerging markets currency. It trades much more like a developed markets currency.
It is interesting to see these dramatic decreases in volume during that, during the peak of the crisis. That's in a way kind of surprising. I mean, I suppose the increasing spreads were a function of it, but given the spike in activity globally, that is a surprising result.
Yes, for certain currencies, we don't have a risk off. I'm sorry, Jim.
I was going to say one example is just if you look at India, US dollar INR, just at one of the reactions to the COVID crisis was asking those traders to work from home. But in working from home, the central bank mandated that they only trade, I think it was 40% of the day. So necessarily volumes decreased as their workday was cut.
Oh, that's interesting. So there's a regulatory effect here as well as a market effect.
Right.
Oh, that's interesting. We have another. Let's move to the next slide, which is sort of a look at sort of the movement from the peak of the crisis to the post-crisis. Do you want to speak to this again, Neil?
Sure, and I'm sorry, there's a typo in the slide title. What we're actually looking at here is how does the markets after the crisis compare to the markets before? So it's pre versus post. So apologies for that. Let's look at developed markets. What I had looking at this picture is a really visual sense of everything just coming back together and converging. It's like everything's trying to get back to 0,0, which is where it was before the crisis. And you see that in the main, it's got there. The spreads, the horizontal axis, are almost back where they were for almost every currency. Volumes are still a little depressed, perhaps 10 to 20% down. But on the whole, you feel the crisis is over. The exceptions for these are the Scandi currencies up on the top left. And of course, Norway went through an oil crisis at the same time as a corona crisis. So that has had ripple effects on the currency. Now, when you look at emerging markets, that same story generally of divergent outcomes plays out. And I tried to illustrate the main direction with an arrow. So first of all the volumes have dropped. They're all meaningfully lower as a group than they were before the crisis. So that risk-off perspective really shows up in this chart as these currencies just being quieter. The other thing you'll start to see is spreads have come down since the peak of the crisis. But they're still in some cases double where they were before. So these are currencies that have not yet normalized fully. And effectively, they're still going through their own versions of the crisis from a currency perspective.
That's interesting. I mean, renminbi looks like an outlier if it had been counted as a developed market.
Yes, what we see there is that the theme of China came out of the crisis early and strongly, and has actually had a very strong economy through the second half of this year. Liquidity is good, and volumes are up.
Well, that's interesting. Okay, and then we have another slide of this type, which is looking at this month, which has been kind of a very interesting one as well. And you see, as you mentioned, significant changes in both developed and EM. Do you want to articulate more of your views of this? Go ahead. I'm sorry.
Yeah, sorry. We were just trying to pick up the way we started the webinar with our discussion of the election. And what you see is volumes last week went up across the board, so the markets were busy. In the case of developed markets, we saw, as you'd expect for a market that's somewhat stable, volumes go up, uncertainty goes up, spreads go up with them. So it's an up and to the right arrow. In the case of emerging markets, the volumes went up, but the spreads actually started to normalize one step further again. So instead of 0 to 100%, they're more 0 to 50%. And our hypothesis here is that these markets, having been very, very thin all summer, finally had enough liquidity with the extra trading to return to something like normal spreads.
Well, that's interesting. It's interesting to wonder which way the causality flows in that. That's very interesting. Jim, before we move on, do you have any thoughts you wanted to put on these slides?
No, I think these are well covered, but thanks.
All right, you bet. Okay. All right, and finally, we'll discuss safety. And this, I think, some of these points were made earlier. I think, the FX Global Code played an unusual role in this period. Do you want to speak to that, Neil?
Yeah, thank you, Ken. So I'd look at the FX Global Code as really a banner for all the work that the industry has done in the 10 years since the global financial crisis. The industry had a lot of work to do coming out of the crisis, and it spent a long time transforming itself. It's worked on conduct. It's consciously changed culture. It's increased robustness in its systems. And it's made a real effort to increase transparency. So across the industry, people are better educated of the way the FX market works and how particular algorithms work. And the Code of Conduct, as you know, it's a voluntary document which really collects the wisdom of the foreign exchange market as to what constitutes good practice into a single document. And this year has perhaps been the first test of whether any of these changes really amounted to anything. I have to say, I think the industry came through really well. We had a massive crisis in terms of operationally how the market operated at the beginning of the year. If you'd said in the middle of January that within 2 months, everyone with a week's notice will pack up their desk, go home, and have to continue their job at the same time as their children stop going to school and ended up living with them being homeschooled, I think you'd have said the industry would be in for some real challenges. But actually, everything went very, very smoothly. There were no major market dislocations. And even though that we've seen spreads increase, last look increased, there was no real sense of, I don't understand why this is happening. There's some scandal here. Am I being treated fairly? An increase in transparency and an increase in fairness in the way trading engines work and algorithms work, I think has paid real dividends in building back some of the trust that was lost in the global financial crisis, to the point where we as an industry should feel really good about where we landed this year, I think.
I think that's go. I'm sorry, Jen. Did you say something?
I hadn't, no.
Oh, I'm sorry. No, I think that really is the case, and I think that this particular the way in which this crisis unfolded, right? I think there really was sort of a sense of the industry pulling together, for this, and in our work, we see exactly the same thing that you've described, right? People were maybe not pleased with the spreads that they had to pay, but they understood why, right? The spreads were wider. It's not that people couldn't get done. It's not that as you point out, like people felt that they were being treated unfairly, right? Spreads widened out because the risk increased, the volatility increased, the level of uncertainty increased. There's a price for that, and that price is embedded within the spread. And I think you're exactly correct that the work the industry has done over the last 10 years to sort of provide that. I mean, both sort of the sense that the industry is working together to overcome these challenges, right, and the transparency you describe. I think that was really key throughout this. All right. This brings us to what to expect for 2021. So I think this is a thing where we'll just sort of describe what our thoughts are. If you haven't submitted your questions, if you have any, please utilize the tool to do that, and we'll address those at the end of this slide. But should I lead off with you, Jim? Can you give us some thoughts about what you expect in 2021?
Sure. So I think first and foremost, the market did come through a difficult period. And I think there's some confidence that although most people will continue to work in some virtual office environment or some working from home environment, the kinks have been worked out and people are comfortable in their working environment. That includes risk management, credit management, access to liquidity. I think through some of the charts that we saw Neil present, the difficulties that we saw during the crisis earlier in the year is not at all what we've seen with subsequent periods of volatility. We've certainly seen volatility spikes August into September. We saw the potential for that around the election, and we really didn't see that sort of reaction in the market. Liquidity has been good, spreads have been better. So I think overall, the stimulus has had its impact. Customers are confident. The system is working. And although the future, we still have volatility spikes related to vaccines, related to stimulus, related to Brexit, I think the confidence going into 2021 that the market can handle these challenges, I would expect to see relative stability.
Yeah, I would agree with that. I think that the interesting thing about 2021 is how little has changed, right? So 2021 was a major shock to the system, but the system rode it out. The system performed sort of as advertised, right? There were liquidity challenges, but they were mediated by price, and that's what they're supposed to do, right? And I feel as though the broader industry agenda is really unchanged for 2021 from what it was in like 2019. Right. I think that what we may see is not so much a change in themes, but perhaps a shift or an acceleration in them. Right. I think the speed with which people sort of shifted to e-trading, their comfort with it, I think that will continue. I think there will be a major focus on automation and efficiency. Right. Especially even though the FX markets performed well, a lot of firms are embedded within larger organizations that may face some cost pressures as a result of the events of 2021. So there will be a huge focus on efficiency and cost control. And I think part of that will also drive an increase in the adoption of FX algos and TCA and the sort of virtual cycle between those. And I think that actually is probably going to drive an increased demand for data, because data feeds both the algo and the TCA engine. And I think the main thing is one of the points that we talked about earlier, which is the need for flexibility, which the FX market structure really has, precisely because there are so many different execution methodologies that are sustained in the ecosystem simultaneously. And I think that the value of that flexibility was really pointed out. And I think people are going to be mindful of that, and they're going to sort of keep in mind the need for that going forward. Those are my 2 cents. Neil, what are your thoughts for 2021?
I think it might be worth picking up, say, customer capacity for change here. So I think the way you summarized it is really good, which is there's nothing really in 2021 that people weren't trying to do for 2019. The challenge they've got is it's proven really hard for our customers to make structural changes while they're in lockdown. This isn't the year you want to install a new rate engine. You probably don't want to change out your order management system while people are working in multiple offices. And so one challenge for the industry is how do we continue that pace of innovation in actually much harder circumstances than we were used to. And coupled with that are the cost pressures. So while trading had an amazing Q1 across the banking industry, all the banks made big provisions for losses in their commercial banking departments. And as you watch the news each day, you can start to see the real economy is struggling. And while the market looks good from what we've talked about today, the real economy is not picking up as a whole. So banks are going to be challenged really to think about how they continue driving through changes in more difficult circumstances and with less money. And I would say that probably means they'll want to lean more on partner solutions, more on vendor solutions, and have to switch from thinking about big transformational initiatives to smaller things they can do within a year, deliver a change, and then think about the next step of their plans.
Interesting. Jim, do you have additional thoughts?
No, I think Neil picked up on it as well. The aspect of cost pressures is definitely something that we're starting to see across all the segments of our customers, and so that will absolutely rely on them being much more selective about the types of innovations that they feel are important. Probably less so, maybe some increased execution capabilities, and more so robustness of systems, robustness of risk management, robustness of credit management, just robustness in the ability to support a large employee base working from home.
Yeah, no, I can see that. The cost pressure, everyone is going to see that. I think that's very true. But at the same time, the flexibility of the FX markets, it gives people quite a bit of capacity. As some of the tools you've mentioned, to manage those costs efficiently, right? Even as Neil mentioned, sort of truncating development and implementations into shorter term projects. I think that those really are important themes for the next year. So I'm going to shift to the Q&A section, the very end here. And we've got about 10 minutes or so left. And we have a few questions here. All right. The first one here is, you've mentioned how well FX markets have performed in the crisis relative to 2008. However, the COVID crisis arose rapidly and receded that rapidly. Do you think the FX markets would have been able to sustain these levels of activity had the crisis been more prolonged? Jim, do you want to take that one?
Sure. Thanks. So I do think that the market would be able to have sustained this even if the crisis had been longer. I think what we witnessed was amazing. During February and March, clients quickly dealt with security concerns, installation issues, lack of bandwidth, not having the screen real estate that they had in their office. They needed to establish new workflows, both internally with and banks between sales and trading and asset managers with portfolio managers and risk managers, and as well as with external, with their dealers, with their vendors. And by June, when we sent our survey, it was very clear that markets had calmed compared to March. And while we've seen some volatile periods, most clients told us that they expected the markets would return to normal by Q4. And in fact, that's, I think, what we've been witnessing around the US election. And I think most customers also thought that by now they'd be back in their offices. But while most customers are still working in these virtual environments, it's clear that the market and each of its participants has adapted. And there's lots of proof points that evidence that that's working, and therefore it will likely continue to work.
That's a great point, that even though the acute financial phase of the crisis has passed, the crisis has not passed, as you mentioned, right? Many people are still working from home. And so a lot of the infrastructural issues, that you mentioned at the top of this webinar, right, remain salient for people, and they still have to adjust to those. The next question here, let's see. You mentioned work across the industry to improve the efficacy of last look. Are there other areas in which industry initiatives might improve trading efficacy? Neil, do you want to take that one?
Yeah, thank you, Ken. I think something to raise here is disclosures. So we've talked in this webinar about how flexible the foreign exchange market is. And that shows itself up in a lot of need to communicate between counterparties as to exactly how orders are being handled, how last look works, and so forth. And disclosures are the documents that banks write to explain how they're actually doing these things. And what we know across the industry is it's hard for banks to write good disclosures. They find it difficult. It's hard for customers to digest disclosures and really understand what they mean. And it's really hard for customers to take 10 banks that they work with and compare the disclosures between banks and understand really what the differences are. So improved disclosures across the industry would really elevate transparency and understanding to the benefit of all. It's something that the Global Foreign Exchange Committee is looking at as part of its current code review. And hopefully, come the end of the year, we'll have something to report as a GFXC on the progress we're making and the approaches we recommend.
Well, that's excellent. That's excellent. That's and we've heard that also, that's a level of interest and kind of a pain point for for FX market participants. All right. Another question here. Given the scale and efficacy of the official sector interventions in the COVID crisis, do you think there's a danger of complacency among market participants? Neil, do you want to lead with that one? I think we all might have views of this one.
Sure. I think there's a real concern that the assumption among the market is nothing can go wrong, and that this crisis is past, and that's almost what the data today says. So the piece I'll pull out as a risk I think about is the risk of a stock market crash. And in the peak of the crisis, you may remember the stock market fell up to 50%, and it seemed like we were going to be in a very different world. And of course, it bounced back, and since then it's hit record levels. But we know that the stock market and the real economy are decoupled. There's a real risk that we're not thinking about, that they'll suddenly connect together and the stock market will be at a very different level in 2021.
That's
interesting. Jim, do you have what are your views of this? Do you think there's complacency?
Sure. I think a related point is so Neil's calling out stock market crash, which I think points to the fact we've had so much stimulus that it's potentially inflating asset values. Something that's related to that is global trade, right? So while the stimulus is propping up some industries, there's some valuations and some industries that might be propped up on the expectation of more stimulus. And if that stimulus doesn't come through or doesn't come through as expected, we could have some failures in different market segments. And with those failures can come credit issues. So I think that one of the things that's really important not to become complacent on is credit management. Now, of course, most of our clients have put in very robust credit management systems, but I think that's the area that we need to watch very closely. As if there's a failure, you think back to 2008, those were the things that became most worrisome.
That's very interesting, and I think that is something that people often overlook, especially given just how effective the liquidity injections by the official sector were. Is that the liquidity issues have been largely addressed, but the solvency issues, which are related to liquidity but are not precisely the same thing, right? Many of those remain unresolved, and I think the point that you make about ensuring the creditworthiness of your counterparties, particularly as a lot of FX is done bilaterally, like that is a meaningful. That is a meaningful thing that I think people might be overlooking. It's hard to know whether or not actually there's complacency or not, because I feel that so much effort was put into addressing this, and that's the level of effort that people in the markets, not the official sector, put in at the very end. I think that actually contributed very much, and it's hard to say after all of that effort was done that there's complacency here. But I think we're just about out of time, and so I think I would ask if everyone has any final thoughts before we ring off.
Nothing from me, thanks, Ken. Thank you.
That's all right. Okay, well, listen, I want to thank both of you. This has been an outstanding and very informative webinar. Thanks for your time. Thanks for all the data and slides you provided, and I look forward to talking again.
Thank you, Ken.
Thank you, Ken. Thank you.
Oh, and I'd like to also ask the audience, I'd like to thank them, and I would like to ask them to fill in the survey about what they thought so we can improve this going forward.